Hey folks, Sam Frio here, the rate update. Today is January 10th, 2022. Sorry for the bags under my eyes. Unfortunately, we had to put my dog of 19 years down yesterday, and it wasn't a good weekend. And I hate to say, it doesn't look like it's going to be a very good week for rates either. So don't go away. That's what we're going to talk about next and why rates are doing what they're doing. Okay, so this weekend I watched a few live events on YouTube, and it was kind of intriguing. I jumped into a lot of realtor live events, and I hope the intention wasn't to make anybody mad. It was just to see what the context was, what people were talking about. And I hate to say it, or I'm glad to say it, about half of the people have mortgage questions. But unfortunately, a lot of the realtors out there they might have one mortgage person that just generically is like, yeah, rates are going to go up. Well, guys, we know that, but can they provide more context? So if you're a realtor out there and I would love to collaborate with you guys to explain to you and your clients what's going on, why is it going on, where do we see things going to, and how you can protect yourself. One of the options we have, and we probably have about $3 to $4 million worth of loans of people that are locked in that are building their houses, and those people are freaking out. I get it. So let me get this context for you real quick, and then we're going to go over where mortgage rates are going. If you're building a house, you should be freaking out because you got pre-approved back when it started. And we have people that have been building for a year, okay? A year ago, rates were 2.75, 2.99. Now they're 3.25, 3.5. They might be in the next month, 2, 3, 4 months, 4. So you qualified at 2.99. Do you qualify at 3.99? That's what you got to worry about. So that's what's going on right now, the context of things. So what I want to go over next is where mortgage rates are going and why. And guys, there is no relief in sight that I see. So let's get on to this area. Let me get me out of the way. So I'm going to post this. I'm trying to figure out how I can share a shareable link to you guys so you can get to this form. There's context on why what's going on is going on. But first, let's go to here. Goldman Sachs predicts the federal hike rates 4 times this year. Okay, that's only to be seen. But there's more to the equation than just that. What I want to do is go over this area in context with you so you get an idea what's really happening behind the scenes. Let's start right here. And this is putting everything in the context. So I'm going to try, like I said, I'm going to try to post a link to this so you guys can access it directly. But let me go over it with you just to give you a pretext of what's going on right now. All right. So, and I'll read this to you, but let me summarize it first so you get it and then we'll validate it with the information on this. What's going on right now is we really haven't seen this exact scenario play out in the past. So the roadmap that we're following is, I hate to say it, there's really no path it's taking because we don't know where we're going from here. But let me put all this in context. I'm not just going to say, like a lot of people, well, rates are going to go up. Let me explain why, how, and what I'm thinking how much. Okay, so the first thing is, we all know that the Fed jumped in and stimulated the economy. They started, reducing rates and reducing mortgage rates in a roundabout way. And I had a big debate with somebody yesterday on that. I'll explain that in detail too. But it was basically quantitative easing. What they did is they stepped into the market in a broad sense and just helped ease credit. Okay, credit for businesses and credit in mortgage rates. So what they did is they started buying mortgage-backed securities. Mortgage-backed securities are what determine the mortgage rate. Okay, so it's not the Fed, or the Fed kind of has something to do with it in tune or in the context that if they're buying mortgage-backed securities or selling mortgage-backed securities, but they don't really determine, they don't go in today and say, oh, we're going to make the 30-year fixed rate today 3.5. And a lot of people think that. Okay, so mortgage-backed securities is the instrument that controls or dictates mortgage rates. The Fed they buy and sell these to create liquidity or non-liquidity. When they're buying, what they're doing is they're stabilizing the prices. So they stepped in, they started buying $40 billion worth of mortgage-backed securities about 2 years ago to kind of ease the markets, okay? And they've done that before. It's called QE. So if you've ever heard of QE or quantitative easing, that's what they're doing. All right. So now what they've come out and said is we're going to stop buying the 40 billion a month. We're going to start tapering. So they're going to taper and they're going to take it from 40 billion a month to 20 billion to maybe 10 to 0 to whatever within the next 6 months. So that alone is going to make mortgage rates go up because you have less demand for that item. So when you have less demand, you're going to cause the prices to start to go down to a point where other people are stepping in to buy that bond to stabilize the market. Okay. As the price goes down, mortgage rates go up. All right. So that's what's kind of happening. But what they're saying, though, is what we're going to do then is we're going to start to unravel all of this, meaning they're going to start selling their holdings. Okay, so when you hear they're going to start reducing their balance sheets, they're no longer buyers, they're going to be sellers. So now let's put this in context. There were huge buyers in the market driving stabilizing the price. Okay, so now with less buying from them, you're going to have the prices start to deteriorate. Okay, driving up yields. But now they're going to start selling their portions of the mortgage-backed securities as well as mortgage-backed securities that are coming on the market. So now you're going to have excess supply with lower demand that's going to cause the prices to go down even further till somebody is willing to buy those bonds. As the price drops, again, you have rates go up. So not only are you going to have less demand, you're going to have more supply on top of it. That's where it's like, what's going on with mortgage rates? Where is the price going to drop to? That's what I'm working on hard for you guys to figure out where and when is this bloodbath going to stop? Okay, so that's basically everything in context of what's going on right now. Okay, so it's a complete reversal of what they just said 6 months to a year ago, saying we're not going to do anything till 2023 and don't worry about it. Well, guys, it's 2022 and they're going to have all this implemented probably within the next 6-8 months. It's never happened before. So how much this is going to disrupt the markets is yet to be seen, but it could be devastating. Okay, so that's that context of what's going on there right now. So we have all this. Let me go through this to you to validate what I'm saying. Okay, so let's read this report. I'm going to just caption it. I won't read the whole thing. I've read through it 5 times and some of it is truly confusing. So let's try to do our best. Seemingly overnight, mortgage rate narrative has changed rather drastically, at least in relative terms. While rates have risen gradually from near-time lows in August, they were still at a historic low at the end of December. A week later, we're at the highest levels in 2 years. So basically, why? All right, there's several concerns. And the biggest concerns, I'll summarize this part here, is traders, meaning bond buyers and sellers and so forth, they don't know what to take of the Omicron and the Delta variant and all that other stuff. So that's basically what this says through here. Bonds feed on fear, turmoil, and risk aversion. If the pandemic outlook might be improved, the net effect is upward pressure on rates. So what they're saying is, if the economy gets better and better and better, we know rates are going to go up because we don't need the quantitative easing and the input of the Fed, okay, with all other things being equal. Whether they're right or wrong, traders are looking past what they've seen as the challenge in January of the COVID variant. They don't know what's going on there. But that's just the general side of the story. There are specifics as well as individual events that can be clearly tied to drama in the bond market. The week's most notable example was an update from the Federal Reserve that suggests even more rapid removal of rate-friendly policies. Okay, so here's where we start getting to the nitty-gritty. And I'm going to read this because, again, it plays huge context in what we're looking at. Okay, we already know the Fed is decreasing the new bond buying, which is called tapering. That means the Fed's bond portfolio is still growing, but at a slower pace. We know that, okay? We already know that the Fed accelerated their tapering process as announced 3 weeks ago. It's already baked in. They did this in order to hike the federal funds rate sooner than later, okay? The federal funds rate is basically what interbank lending, okay? They didn't say mortgage rates. They didn't say, credit card rates. They said, federal funds rate is what they control. Okay. The bond market has done a good job digesting all the above, because according to the Fed's playbook, they would still be reinvesting 100% of the proceeds from those bond holdings for quite some time, even as the rate hikes begin. The last time they normalized policies in this way, there was a 2-year gap, okay, between the first rate hike and the first instance of balance sheet reduction. Okay, so previously when they had, they started buying MBSs, they unwound it over a 2-year period. Well, the guidance we got so far is we don't know how quick they're going to dump this stuff. That brings us to this week's big news. The minutes of the Fed's last meeting were released on Wednesday. They offered new insight on the Fed's thinking. To make a long, boring, complicated story very short, they're not using exactly the same playbook this time as they did before. In fact, rather than 2 years, it looks like the balance sheet runoff could begin only a few months after the first rate hike. Okay, so they're condensing all this stuff into a very short time frame. That's scary, guys. Okay, which much to the market expecting the rate hikes in March, that means the balance sheet runoff could start as early as June. At least one Fed speaker confirmed such a time frame by the end of the timeline by the end of the week. That would mean the Fed's move from tapering announcements to balance sheet reduction is just over 6 months, versus the last time it took them 2 years, and in some instances, it took them 4 years to do this. The same process took place 4 years later when we had the 2013 tapering and the 2017 balance sheet reduction. All the above is a bit sudden as far as the bond market is concerned. Simply put, traders are rushing to get into positions for the new reality. And that's why we saw a 100-point move and or more just last week in the MBS market. One other key point this week was the employment situation reported in December, the AKA non-job farm payrolls. I posted that on Friday, and I showed you where CNBC and myself are basically completely confused with all these numbers. Okay, so that's what's going on with the employment and the mortgage-backed securities. Ultimately, though, the most important part of the jobs data was that it wasn't encouraging enough to raise any major objection to the Fed's message from earlier in the week. Until Friday morning, some traders may have been holding out for that. The bottom line is that it's very big, very important, and relatively abrupt repricing of expectations is taking place. Okay, so that's what's basically going on. The Fed is no longer feeding the drug-induced economy. They're going to actually start selling the drugs. That's probably a bad analogy. My bad. So that's what's going on. That's what's so hard to follow with all this stuff. So what effect is this having on us right now? Well, let's see where the rates open for the day. And let me tell you where we are so far. So we have the 30-year fixed rate right now at 3.5. It's up 3 basis points. The 15-year is at 2.77. The 30-year FHA VA is at 3.10. The 30-year jumbo is at 3.26, and the 5-year ARM is 3.8. You can see they are going up. If you look down below, we see the 52-week range. It's the low and the high. So the 30-year fixed, if you follow this, was the 52-week low was 2.75. The high, 3.5. Where are we? 3.5. Okay, you can almost see that all the way across the board. All right, so that's what's going on with there. So now, how's the market digesting a lot of this stuff? Well, not good. Let's refresh this thing because it is continuing to crash. Oh, we had a little reversal. You see that we went from 0.33 down to 0.23 down. This is what we've been seeing, guys. Okay, so we see this kind of crash in the market. Again, when we're following these trends, when this is what's going on to the price of the bond, okay, right here, this number right through here. Again, when this number goes down, rates are going up. And that is a big move. You can just see from, let's go over here, just when is this? Last year at this time. Let me see if I can condense this to, let's see a 3-month. Okay, so within the last 3 months, we went from a 104.5 to a 102.5. Okay, guys, that's a 200-point move. It's huge. Okay, so that's what's going on. The economic calendar for this week, Federal Chairman Powell is going to speak at 10. That can and might rattle the markets. Let's see how good he can spin this thing. The next thing is we have on Wednesday. So really, I'm sorry, this news is for tomorrow. The federal chairman's going to speak tomorrow. I'm going to be right at my computer waiting to lock or not based on every word he says. Then we see on Wednesday, there's really nothing there except core CPI. That's giving us a somewhat of an inflation number. The Fed watches this, but this isn't their key indicator. And then Thursday, we have the jobless report coming in. We're going to see how that goes because that gives us numbers on the job front. And then we go down on Friday and we see retail sales and core sales and everything. That how the economy is really doing or how the consumer is really doing. So that is it for that. So now your playbook. If you've been on the fence, I would highly suggest you jump off the fence. And what I mean by that is if you're waiting for rates to bottom or you're still shopping around, please stop the shopping. I'll tell you this, send your application to us. Why? What are you looking for when you're trying to get a mortgage? Somebody that's compatible with what your thoughts are. Somebody who knows what they're doing. Somebody who has a good track record. Somebody that has good rates, great fees, and you know them. Okay, that's hard to do, especially in this. You might know the guy that you buy your car from because you always bought a car from. You might kind of know the person you did your mortgage back 10 years ago, but are they still in the business? I'm here every day, guys. I'm here every day. Watch my videos every day. We joined the largest brokerage in the country. What that means to you guys, we shop your loan to over 130 lenders throughout the country. How could you do that on your own? Okay. However, if you've shopped, what I ask you to do is send us your loan estimate. That loan estimate is telling you what that lender that you went to is giving you. Okay. It doesn't have any information that could be hacked or I could jump in and do some fraud there. Basically, what the loan estimate does is it tells me your name and address, your property value, the loan amount, the rate, if it's locked or not, and then where every penny of that loan is going. It's going to pay off your mortgage or you're going to buy a house. But what are the costs? And that's what we analyze. We not only analyze your rate, but your costs, okay? So now on another piece of the equation is if you're building, should you be freaking out? Yeah, okay, why? Well, you got pre-approved a year ago at 299, rates are 399. Do you still qualify? Do you qualify for the program that you were in? Okay. Will you qualify if and when rates hit 4? Might be before your house is done. So we have, in many cases, we can lock you up to 3, 4, 5, 6 months. Okay. And we stopped it at 6 months basically because hedging further than that, the costs were too much. And it's not it's not something a lot of lenders are looking to do right now because it's too risky. So if you want to lock in your loan up to 6 months, please call us to see if it's eligible to you guys. If you're in the process of getting a mortgage right now, please email us. And all the emails are and all that information is down below. But what I ask you to do is please call us. Please call us. Your situation is unique. So up in the top over here, you're going to see the phone number. 844-775-5626 is the best way to call us. If you're like, hey, I can't get there during the day or whatever, and I need a meeting, please schedule a meeting for you. You click the calendar link, and it's going to open up our calendar and give you all the times and days we have available. Then the next thing is, if you're like, hey, I just need to get this going now, click the apply now button, and you're on your way. So thanks again for watching, guys. We did hit the 19,000 subscribers. Thanks to you guys. And I did a special video on Saturday. I hope you check that out. It got about 4,000 to 5,000 hits within a couple hours. So thanks to you guys for doing that and helping me there as well. So sorry that the video is so long, but I hope we packed in a lot for the punch on what you're getting here. So thanks again, guys. Take care. Have a great day, and I'll see you around 4 or 5 o'clock. Bye-bye.